Hello traders, my name is Kululeko Zondi, aka Pips DJ. Today we're going to be looking at basic concepts dictionary. We're going to be just covering the basics of how to get started in the forex markets. So sit back and relax and get ready to get liberated in terms of just growing, in the space of trading the financial markets. To begin our discussion, we're going to be looking at what is forex. For the purpose of a trader and a need to know and a very very brief summary of what forex is, it's basically a market where participants are on a global scale, so you get participation from all over the world, and you find that currencies are being sold for other currencies, so currencies are valued relative to other currencies. As an example, here we have the US dollar, South African rand. So whenever you're looking at a price chart of a US dollar South African rand, you're going to be looking at the price of the dollar, which is the base currency, according to the South African rand, which is the code currency. So that's why you find that on the chart the price that's presented is the code currency, which is the ZAR in this case. And then on the actual movement of the chart, it's actually the asset that is being represented in terms of value is actually the dollar, which is the first asset. Because for example, if you look at a US dollar ZAR chart and you see the chart is bullish, that means that the value of the dollar is rising against the South African rand. So basically that's somewhat what forex is. And in order for participation on the global scale, we need basically a link for all the participants to be able to basically trade amongst each other. So what happens is the globe has basically different countries in the world have different banks that create access to the global market, and via these banks retailers and brokers and other financial participants also connect to this global market. So for retail traders to connect to the global market, you need to have an account with a broker. So you need to connect to a broker, and then from there you basically process your orders via the broker. Some brokers actually process the orders for you, so basically they'll take the other side of your trades, and some brokers actually just send the orders into the market, and then you find liquidity from the rest of the market participants. So that's basically just a brief summary of what forex is, in order for you to be able to know what you're doing in terms of just being in the space and learning, and also applying what you know in terms of like trading, and also just interacting with the various steps in terms of like opening an account, where to open an account, why do you open an account with them. So that's just to sum it all up, which is what you need to trade forex. So basically what you need to trade forex is a trading platform. So basically the trading platform is what shows you your charts. That's where you open and close your trades. That's where you will be basically analyzing the markets. If you are also some traders that use like analysis techniques that require charting, so that's where you're going to be basically doing everything when relating to operating your trading account in the financial markets. And then from there you also need an internet connection, because it's a live market. So in order for you to get like prices now, as the asset price changes, you need to have an internet connection, and you need to have a decent connection. You need to have like good coverage, so that you can always like have up-to-date pricing. You can always get like quick orders, order execution, because sometimes you'll find that if your internet connection is very slow, you open the trade, but then the trader will only confirmed like after a while, and you find that the markets had moved quite significantly, and then you entered very late in the market. So that causes like something which is called slippage, because your account would have a bad connection to the server, so you end up having those kind of problems. So to avoid those kind of things, you just need to have a decent connection. Doesn't have to be a very high end or expensive connection, just has to be a good one. And then you also need to open an account to the broker. At this point in time, you don't have to worry about that, because as we're working in the group, we'll be sorting that out, because we're going to be also working on some prop firm accounts. We're going to be working on competitions, that kind of thing. So you don't need to worry about the broker for now. As long as you install the trading platform, you'll find there's already an account there. You'll just need to fill in your details and just have a MetaQuotes account, and then you'll be using that one for now. And then a system. So basically, a system is something that will tell you basically how to enter the market and exit the market. Basically, what you're going to be doing. What's the plan. Some people rely on their guts. Some people have rumors, they rely on news, they look out for events. Some people like do everyday analysis and trade, those kind of things. Just make sure that whatever system you use, it's sustainable. And our system, as you will learn, is a technical wave analysis. And we've also got technical analysis price action. So those are basically the two very beginners. The one is a beginner, and the one is a beginner to advanced certification. So we basically use those strategies to enter and exit the markets and to make our trading decisions. So yeah, so that's basically the technical aspects of just what you need and how to go about doing it. You start by downloading the trading platform from metacodes.com, or you just simply go to your Play Store or your App Store if you're using like other devices other than Android. And then as soon as you have the app installed, or the desktop application or Mac application, you'll find that it will open up. For the mobile application, it gives you an option to create the demo account instantly. You start populating the fields with your information. You create a password, you verify your email, and then you can start just trading those charts, like modifying the codes, those kind of things. So basically with the demo account you can start doing that, and you can also set the size. They have like a selection of sizes you can select from, so you just do that. And then for the PC variation, what you do is you just go to create an account, and then you create demo account, and then from there you follow the wizard, and then you create an account, and then from there you can start having access to the different prices and charts and open trades and close trades and analyze. Basically you'll be having access to all the functions of the terminal except the withdrawal function, because you can't withdraw if you did not deposit, and also the deposit as well. But you'll have the access to everything else. You'll be able to run indicators, experts, advisors, whatever you name it. Yeah, so that's basically a brief rundown on how to get started. Okay, from this slide onwards, and I think for a few slides after that, it's going to be just terminology to help you settle in. So I'm not going to be going into the terminology. You're going to have to just pause the slide and read it for yourself, and then also the next slide you just pause it and read it for yourself and understand it. Yeah, for now I think that's all. There's nothing complex that needs a lot of explanation on the slide, so I'll just move to the next slide. On this slide, the only interesting part, it would be the spread. Spread is basically profit for the broker, because they're giving you access to the market, so they also want a percentage, like in terms of payment on the order flow. Some brokers charge order flow. So basically what that means is that they will charge you based on how much you trade. So if you're trading a lot, they'll charge you a lot. So if you trade a little, they'll charge a little. So it's a fraction of what you trade basically. and some guys actually just charge you commission, which is separate. So guys with spread are the guys that normally don't charge you commission, and then the guys that don't have spread or very tiny spread are the guys that charge you commission. So they'll charge you maybe $30 for like one lot traded, so that's basically what spread is. And also spread is the difference between the bid and the ask price, and the bid price and the ask price is basically all explained here. These are just basic stuff. You don't really need to know them like in terms of using them again, but you need to know them in terms of understanding the different functions on the trading terminal, as you're reading, as you're using the terminal, opening and closing trades, you know what they mean, so that if you want to use them, you know what they mean and you can use them. So that's basically it. Okay, in this slide, the important thing is that there are two types of orders. You can basically execute an order now, which is called market execution, or you can execute orders at a later stage. You can basically program an order in and then just wait for, or just carry on, and then if the program parameters are met, the order will then be executed. For example, a buy stop, that's basically you buying a higher price from the current market price. So all these orders are going to be based from the current market price. So if you are placing a pending order, you're going to be placing it based on the current market price. So a sell limit is different from a sell stop in that you sell at a higher price. So if you are selling at a higher price, that means that the price is still going to go higher and reach the price that you want to sell at. But whilst a sell stop, you sell at a lower price. So that means that the market is moving lower, and when it reaches that price that you want to sell at, you will sell at that price. So just be wary of those differences, because they're significant, because it's the kind of order you take and it's the kind of entry you take. And these are good practices, like to use pending orders, because you're not necessarily in the moments of things where sometimes you're stressed, you're trading, you're stressed, you're under pressure, and you're taking trades, but with pending orders, you take out the emotion, because you just you leave the order there, you analyze the market and you see your potential entry and exit, you leave the order there, and then you come back and check it after a while, so there's an upside to it and there's also a downside to it, but it's up to the kind of trader that you are and what you ultimately feel comfortable doing. Okay, so basically trading forex has a lot of layers to it, because firstly you're gonna need access to like the tools and the platforms and all that, which is the technological environment. And then also you're gonna need access to the knowledge, of how to actually use the trading platforms, use the tools to actually analyze for trading decisions, which now becomes the philosophy of how you see the market. So basically one of the major schools of thought in terms of those philosophies is technical analysis. And technical analysis in a nutshell is basically the idea behind behind crowd psychology, is that what has happened before in the markets tends to happen again, because people tend to buy and sell the similar goods and services. So the trends in the market tends to be the same, in terms of seasonality. Sometimes you get like guys who study seasonality and use seasonality to trade. You get like guys who study in terms of economic growth. So you get those guys who use like your fundamental aspects of the economy to trade the market, and which becomes another branch of trading the markets, So, and technical analysis is basically a branch of the market that looks at the price. So what essentially you need to be a technical analyst is basically to practice using a chart. And basically what you do is you use the charts, you analyze the charts, and you make your trading decisions based on what your chart analysis tells you. So technical analysis is one of the biggest schools of thought in trading, which is why I introduced it first, because it's more of an overaching, and then all the most of the other strategies are behind it, are under it, because they, in some way or the other, they'll use technical analysis to actually interact with the chart. So it ends up being something that is of significant and to understand, which is significant to understand, and also very, very important to use. So basically in this slide, we're going to be exploring a few concepts of technical analysis, which is firstly, the first concept would be your trend line. Basically, okay, the first concept would be a trend. It's not it's not described or defined in this chart, because it's actually being used as it's being analyzed. So basically the market is the black line, so that's the price moving up and down, up and down, and then from there the market tends to make these highs, you know, these points that go higher, and then it tends to move in the opposite direction. So at the point where it turns, we call those points either a high or a low, and then those points in technical analysis are referred to as resistance. So basically those points are resistance because people are resisting to buy the market higher, you know, so that's why it's resistance. And then these points here where the market now goes in the opposite direction after it had been moving down and starts going up again, those points are referred to as support. And two or more supports joined together by a line, and then that line being extended will form what is called a trend line. So basically that's the blue line you see here. That's basically the trend line. So basically these three concepts can tell you what to look for in terms of like what is coming next in the market. For example, at this point here, so at this point here, let me just grab a pen. At this point here, the market could easily do that, you know, just continue to do that, you know, that type of thing. So you waiting here and taking a trade here and maybe having a stop loss somewhere here or somewhere here, this trade here would be maybe a 1:, here it would be a 1:2, and here it would be a 1:1. So basically here you'd be risking 1% for a 2% reward, because you'll be looking at breaking this high here, you know. So, and then with your stop loss below here, you're looking at something which looks like a 1:2. So for 1% here of risk, you'll be standing to take a 1% gain, you know. So basically that's basically why these key levels are important, you know, for you to understand. So I'm just trying to show you just a simple application of those things in terms of how you use them to trade. Okay, in the previous slide we mentioned that technical analysis is like an overarching philosophy or a way of looking at the market, or a methodology. And then after that we also have fundamental analysis, which is looking at like the economic events and these kind of things. And then we also have wave psychology, you know, which is a psychology which was studied by R.N. Elliott, who is regarded as the father of the Elliott wave principle. The study that continued further, and since we have also studied further in terms of like wave psychology, and we developed a strategy which is technical wave analysis, which is also based on the philosophy that technical analysis and wave analysis come together to give you what we use as a approach to analyzing the market, and also trading the market, and also managing risk in the market during our trading, and also off trading, because we also just do off trading. So we also just make sure that we monitor ourselves on and off the market, basically to ensure that we maintain good habits throughout. So basically, with a wave psychology, the idea is that the market is basically moving in sort of like waveforms, you know. So basically, those waveforms are repeated over a series in time, because the people that are interacting in the market are basically human beings, and human beings basically do the same things over and over again, you know, like year in year out you'll find people will be doing the same things, similar actions will be happening in the economy. Money will be moving in similar patterns, you know. You get those busts, you know, of like where large inflows or outflows of money happen, you know, maybe large acquisitions or large mergers globally, you know. So like those transactions tend to make the market, you know, like move rapidly in terms of value. And you also get news events, you know, where economic releases are being made and people are starting to make like long-term trading decisions, so they tend to like invest a lot of money, and you tend to find markets moving in a certain direction and then changing. You get spikes. So those things happen in the short run, but what we are looking at and focusing on is the long-term trend. So what we analyze is, when we're looking at the trend, we'll be looking at the trend from the beginning of the time that we have been monitoring the financial markets and financial assets, which is around about the 1970s. So most charts go back to around about the 1970s, but your broker charts and those types of charts, they don't go so far back. So in order for you to go to like those really far back charts, there'll be details in the course about how to do that. For now, let's just look at the introduction, so we can not make this video very long. So basically that's the waveform, and the waveform will basically give you information about the market. And the first piece of information we get using the waveform is that there is an impulsive phase, which is the direction where the market is going. So if the market seems to be going up, which means that it's making these highs, then the impulsive direction would be the up direction. And then if the market is going in this direction, then that would be a corrective phase of the trend. And any corrective phase of the trend, because the move is counter trend, the impulsive direction of a corrective trend is also counter to the impulsive phase. So the corrective direction of the impulses will also be in the corrective direction. And so basically the impulse will always be in the direction where the trend is going. So that, as you can see here, the impulses are represented in blue. They are all moving to the upside because we are at the impulsive phase of the trend. And this side here, all the impulses are moving to the downside because we are in a correction, you know. So these are very important, because at a certain point you can tell now, using this information, you can now be able to say the market made this up and made a correction. I can wait here for a trade. The market made this up and gave a correction. I can wait here for a trade, you know. And then here I can take my profit somewhere here, you know. I can wait here for another trade, you know. So basically this gives you an edge over the market. It gives you something to wait for, you know, something you can expect. Because if you enter, like for example, at point, let's say this is point number 1, if you enter at point number 1, you'll be taking profit from that move. And then if you enter at point number 2, you'll be taking profit from that move. And then if you enter at point number 3, you'll be taking profit from this move, you know. So basically that's your profit, and then here that's your profit, and then here that's your profit. So that's profit, profit, and also here it's profit. So you see, just from these three trades you can make a lot of profit, you know. And just by using and applying the wave principle, you know, accordingly, you know, just by using this way of looking at the market, you already have an idea of where you're going to be waiting for your trades, where you're not going to be waiting for any trades, where you're not going to be doing anything, you know. And also you must also understand something. For example, this side here, the corrective phase. The corrective phase of the trend is very dangerous because there's a lot of corrective structures. So what may happen here, sometimes you find that this would happen here where the market will come up and then come back down like that. So if you have entered here and had your stop loss somewhere above here, you will you'd get taken out, and then the market would also move in your direction. So when you're trading corrective structures, you need to be on your toes. You need to always pay attention to what you are doing. So I was just bringing that up so that you can also just keep these things in mind as you are just developing your idea and understanding in terms of wave psychology. Another major school of thought in the discipline is candlesticks. Candlesticks are basically a system of looking at the market that was used by rice traders in Japan. And it became very famous because one of the guys made a lot of money trading candlesticks, using candlesticks, and he made a lot of money. And yeah, it basically was adopted by the West, and is also still being used today in our trading terminals. As you can see, whenever you're looking at the platforms, you normally find traders looking at the chart in the candlestick form, because it has this graphical aspect of it. It has this large body. We'll discuss that on the next chart. But what's important is that candlesticks are basically a tool for us. It's not a system for us. We don't use candlesticks to trade. We don't make the trading decisions based on candlesticks. We look at the charts. We look at basically the pattern, you know, what structure the market is forming. So we don't trade based on like candlesticks, but we do observe candlesticks and we understand what they mean. So we involve them in this dictionary because we want you guys to also just know that you need to just understand what they are, so you know what they are when you see them on the charts, and you don't have a misconception or misunderstand them for something else. As I mentioned in the previous slide, candlesticks are very graphical. As you can see here, we have basically the body of the candle. This is the body, and then we have this this little line. This line is called the wick. So basically, as the market moves, because prices tend to do that, because prices move in this sort of fashion, right? You know, so over an hourly period, prices will be doing that, you know. So you tend to get this wick forming, and then let's say, for example, for this candlestick, as it's red, what that means is that for this period, let's say if this is an hourly time frame and we see one candlestick like this, which means for 1 hour the market opened at this price, and then it made this high price, and then the lowest price it made was this price, and then it closed at this price. So the price change from the previous hour would be this much. Basically, that's basically what a candlestick tells you, and it tells you that the highest price that was achieved within the previous hour is this high, and the lowest price that was achieved in the previous hour is this high. So this information is useful because you could be looking at a daily chart, an hourly chart, a weekly chart, so a candlestick just basically sums it up for you very, very, very nicely. There are other ways to express your charts. There's lines, there's bars, there's area, there's so many different ways. There's like different kind of charts. There's a tick chart. You get your stick and figure diagrams. There's a lot in terms of like charts. Yeah, there's so much. But now you don't want to be, unless you want to be someone who's doing like as a sport or a hobby, you can go into those things and just, but if you're someone who just wants to know these things so that you can apply them in the market and make money, then this should suffice for you. So the important things here that you need to understand is the body of the candle matters, because that's how much it basically shows you how powerful the move is. And as you see in the following slide, we'll have a more discussion on candlesticks. As mentioned earlier, the body of the candlestick matters. As you can see here, for example, this candlestick has a smaller body with the one to the next of it, So what happens is basically the market had gone up for this period, and then the next period the market started at this price, went higher. It actually opened at a very high price. It opened here and then went higher and then came all the way down and then even went lower and then closed lower, So it closed lower than the open here. And so that basically tells you all this price action was reversed in one period, basically. So that tells you that the move after the second move is basically stronger than the first move, which tells you that maybe we are getting a lot of selling pressure in the market, So this is something you'd get at areas where the market is somewhere like that, maybe trying to do something like that. This is where you'd get something like that. So basically this first week here would be looking like this one here. It would be something like here, and then the second week here, which is this one, would be this section where the price goes up like that and then starts doing that. Then this one is obviously different from the first one, so basically you get something like that there. And then this is basically to tell you that there's a possibility that prices can continue doing something like that, so basically these are all the things that you watch out for. So as you can see, I use a wave psychology to look at the market, but the candlesticks, I understand them and know where they are. So whenever I'm looking at a chart and maybe I identify this pattern or any other candlestick pattern, I can understand what's happening in the market, because I know what candlesticks mean. So that's why they're introduced in this dictionary, so that you can understand why they're important and also what they mean. And then as you can see here, the body, for example, the smaller one in here and the smaller one out in here as well, the body is very small. So that's to tell you that a very small price change happened. So if a very small price change is happening, that means market is probably doing something like that, So this would basically be a small candlestick like that. Or if it does something like that, so basically there's a very, ultimately you get in maybe this whole period here, you get just this candlestick that has this wick. So it'll basically be something like that. So this will be the high and this will be the low. So yeah, that's basically it on candlesticks. Okay, that sums up our lesson for today. So guys, please just like and subscribe to our channels and also our other platforms as well. Whenever we post, just react and also just comment, so that we can know what you guys are going through, what you guys are thinking, so that we can also just help you guys further. Because even though we have some of the free content, it's also very helpful, and we ensure that it's also quality knowledge that will help you guys in your journey to becoming consistently profitable traders. So guys, keep being sustainable and maintain your habits and stop the bad stuff that you do. Pips DJ out.